Hi everybody, Dana Sparks, broker of Maximum One Greater Atlanta Realtors, and today's contract tip has to do with the question, may a buyer change loans after they go binding with a seller? And that is a very interesting question. We are going to explore that. So first of all, let's talk about the GAR, the Georgia Association of Realtors contract, and let's see what that says. For those of you who have been in my classes, you have heard me say repeatedly that your contracts are a set of instructions. So the first place to go find an answer to any question you have would be, let's see what the contract states. So if a buyer and a seller are binding under the Georgia Association of Realtors contracts, let's take a look at what that says. And in the GAR contract, it says, well, we're going to look at the loan contingency. So before we even do this, let's think about it a little bit. There are conventional loans, and then there are government insured loans. So if there's a government insured loan, well, I want you to ask yourself, what's the difference between a conventional loan and an FHA or VA loan? There are a lot of differences. One of the main differences, well, before I get to that, because this will get explained. Let's look at the conventional financing contingency in the GAR purchase and sale agreement. And that is GAR, Georgia Association of Realtors. That is Form F404, Conventional Loan Contingency Exhibit. And it does state, basically, any loan contingency, if a buyer and a seller go under contract with a financing contingency, the seller is saying, okay, buyer, I give you X number of days to go convince a lender to lend you the money. You can do whatever you want, but this is the number of days. If, however, your contract with me is contingent upon that, so if you cannot do that in that time frame, I will allow you to you get your earnest money back. However, if you cannot convince a lender to lend you the money, number one, you must terminate prior to the end of that time frame and let me know, and you must send proof of it. However, the proof that you send, the loan denial letter, there are very certain specifications on what that can be, and I've addressed those in previous videos. But the loan that must be denied must be the loan that is described on the exhibit that we agreed to when we went under contract. So in the GAR loan contingency exhibits, conventional FHA, VA, and USDA, they all say that a buyer may apply for a different loan. However, a loan denial letter for any other loan that they apply for shall not meet the terms of the financing contingency in the contract. In other words, if a buyer does apply for a different loan, which they are more than welcome to do, if they get denied for that other loan and terminate the contract based on that, their earnest money is not protected because the purchase and sale agreement is contingent upon them getting, or their earnest money is protected if they cannot get financing for this loan as described on this document. Now, in essence, it doesn't matter how a buyer comes to closing. A buyer has until the day of closing to figure out how to pay for the property. The financing contingency exhibit is just for protection for the buyer's earnest money should they not be able to convince a lender to lend them that specified loan. But in essence, for every seller, our contracts are all cash for the seller at closing. They're all cash contracts. I mean, let's face it, the seller doesn't have to wait 15 years or 30 years to get their money. The seller gets their money right then and there at the closing table. So now, what if a buyer goes under contract with a seller, for example, with a conventional loan, and they find out that they want to switch to an FHA or VA or USDA loan? Well, now is where we go back to the contract and read the instructions and see what it says. So in the GAR conventional financing contingency exhibit, which is GAR F404, under paragraph 3, it specifically states Buyer may also apply for a different loan. A loan denial letter, as I just went through, however, must be from the loan described above. But a buyer may apply for any sort of other different conventional loan, different interest rate, different length of time, so forth and so on. However, again, the denial of other loan cannot be the basis for termination. Now, notwithstanding the above, the buyer shall not have the right to apply for an FHA, VA, or USDA loan unless the parties agree to amend this agreement, the purchase and sale agreement, to add an FHA, VA, or USDA loan contingency exhibit that meets FHA, VA, or USDA requirements as the case may be. And once they do that, this conventional loan contingency exhibit shall no longer be part of this agreement. Nothing herein shall require the seller to agree to amend the contract to an FHA or VA loan if they had agreed upon a conventional loan. Now, there's no verbiage to that matter if a buyer and a seller go binding with the buyer getting an FHA insured loan or a VA insured loan or a USDA insured loan. Again, we're still talking about GAR. Now, in the RE forms, under the standard terms, it doesn't have that exact verbiage, but under the paragraph 6.3 where it talks about financing contingency, it does say, again, the termination protections are the same for the buyer, that the loan that's terminated must be the one as described in the financing contingency when buyer and seller go under contract. But it does say that if, however, Fannie Mae, Freddie Mac, FHA, USDA, or VA underwriting guidelines mandate compliance with underwriting criteria, then obviously those criteria, those provisions shall prevail and be binding upon the parties. However, if any of those guidelines result in an increase in costs or expenses to the seller or affect the date of closing, then first of all, the buyer must send notice of that's going on, and then the seller, at the seller's sole discretion, may unilaterally terminate the contract within 3 days of receiving the buyer's notice of increased cost to the seller or a delay in closing. There's more about that when we go through the entire RE contract. Please check the playlist for RE form contract CE dissection. There's a whole long explanation about that. But back to the topic at hand. So, may a buyer change a loan? Well, it depends. If they're going to change from a conventional to FHA or VA, it's a bit tricky. Why is it tricky? Well, part of it was just the hint we got in that RE form standard terms. Because an FHA or VA insured loan, the seller is going to incur costs that the seller would not otherwise incur with a buyer getting a conventional loan. So, number one, there are certain fees that a seller must pay with an FHA loan, and even more fees that a seller must pay if a buyer is getting a VA loan. So those are costs insured by the seller that the seller did not initially agree to when the seller and the buyer went binding under the contingency of the buyer getting a conventional loan. Additionally, an FHA or VA appraisal stays with the property for 4 months, where a conventional loan appraisal does not stay with the property. So, depending on the circumstances, the seller might not agree to have an FHA or VA appraisal on their property that is going to be attached to that property address for a certain period of time. So, it's very, very tricky going from conventional to one of the government insured loans versus going from an FHA or VA loan to a conventional loan. So again, a buyer may purchase a house through any means they choose: loan, cash, FHA loan, VA loan, conventional loan, USDA loan. They can cash in their investment accounts. They can win the lottery. They can do whatever. Again, at closing, it is all cash to the seller. But you must look at the terms that the buyer and the seller agreed to regarding any sort of financing contingency and what happens. What happens? I mean, what the consequences are to both the buyer and the seller. Additionally, if there is an appraisal contingency, the appraisal contingency rights under the FHA and VA loan exhibits, if the appraisal comes in low, are vastly different. The procedures and processes per the contract are vastly different in GAR if a buyer's getting a conventional loan or an FHA or VA insured loan. So not only does it affect costs, potential costs, well, hard costs to the seller, but it also can interact with the appraisal contingency. So it starts to get a little bit complicated if a buyer is switching loans, even going from FHA or VA to conventional, again, because regarding the appraisal, there are various appraisal contingency processes and rights that each buyer and seller have should the appraisal come in low. So make sure to read your contracts. They are instructions, including all exhibits. If you have any questions, please make sure to check with your broker and with the lender, and make sure, and the co-op agent. So I hope this contract tip helped you out. Thank you so much for watching. Dana Sparks, broker of Maximum One Greater Atlanta Realtors, satisfying your needs with service, innovation, and education.